Hey everyone. So, what I wanted to take a few minutes to do is I'm going to go ahead and mark up the chart just as I would, even though this is obviously the day's closed. I'm going to go ahead and mark up what I would mark up if this day was starting right now. So, obviously, we would be over here and not to the left. But one of the first things I do, I try and keep it really simple. And one of the first things I look for is the low and high of yesterday. By the way, I've got StreamYard on this side of I've got a large monitor. StreamYard's over here and TradeStation is over here. So that's why you see me going back and forth a lot. But what I'll often do is, I could put a line at yesterday's low, but it's so far away that I know we're probably not going to get there. But most of the time, I will put a line right there. I'm going to put a line at yesterday's high, which is right here, bar 81, and I often make that blue. And then what I do, and I'm usually thinking through this when I'm writing the morning blog, but I will take some time and think through the daily chart. So, what are logical areas of support and resistance? One of them is going to be round numbers. So, I know that 4,500 is right here, and you can see it's no surprise. Look at bar 12, 4501. So I'll go ahead and let me turn on snap mode. I'll go ahead and turn and just mark 4,500 right there. And then, other than that, I'm always thinking about, and I'll just label it 4,500 BRN for big round number. So we've got yesterday's high right here, and we've got 4,500. And I'm also going to think about yesterday's close. So I'll go to the daily chart after I do that, and I'll just look at this and think for a minute. If you read the blog post, one of the things I mentioned was we had a really big bar right here, and it's a surprise. Surprises generally get second legs, but big bars in a trading range environment, you always have to wonder if it's going to be a little bit climactic. So let me see if I can show an example here. So here is the euro dollar, and this is a 60-minute chart from August the 1st. But you can see you had a really big bar right here, and this is a trading range day, and it's two legs up, leg one, pullback, leg two. Really big bar, and what you don't know at the time, let's just full screen it. You don't know at the time this is a big bar, and it will generally get a second leg. But if you buy the close of the bar and you don't wait for follow through, and then you get this big bear bar, look what happened right here. The market tried to test the high close and failed. So if you buy here and then you get bad follow through, a deep pullback, what are you going to do on your retest? You're going to try and get out. So a lot of traders would get out there. That's a little bit different than right here. This was August the 29th. So this was yesterday, actually. And this is bar 1, 2, 3, 4, 5, 6, bar 7. Bar 7 was pretty big. But if you look at bar 7, the context is a fairly tight channel. And when you get a big bar like this in a tight bull channel, I'll just show it let me just show it actually on TradeStation. So it's easier, so we can see the context better. So here is bar 7. It's a big bar, but it's in a fairly tight channel. These are more dangerous buys, but because it's in a tight channel, it's probably going to go at least a little bit higher. So back to the daily chart. Big bars like this, I'm always thinking, always in long, we're going to go higher, most likely. But I'm always wondering if we're going to get this, a bear bar closing on its low. So if I'm a bull and I'm long, this is why I think it's so important to understand swing trading. If you're a bull, and it doesn't matter if you bought here, if you bought above this second entry buy right here, the swing trade is still in play for the bulls. But if you're a bull and you bought above this bar or you bought the close of this bar, and today was a big bear bar closing on its low, that might be enough reason for traders to get out. Now, the fact that this bar closed so far above the moving average is good for the bulls. And that increases the odds that traders are trapped. So you had some traders, this was reasonable. It was reasonable to sell the moving average here. And that's what led to a second leg. It was less reasonable to sell here. But look what happened. Bears sold the moving average, made money. Sold the moving average here, made money. Sold it here, made money. Sold it here, made money. And they're going to keep doing that until the market begins to fail. Here, it failed. So the traders that sold, they got trapped yesterday. And because of that, I thought there was probably would be buyers below. Today, we have follow through for the bulls and a fairly small tail. The low of this bar is 45.01 and the high of this bar is 9.5. So that's a very small pullback. And what that shows is traders were buying the close of yesterday, and that's good. Now, we look at this bar, and it's easy to look at it and say, yeah, this is a good bar for the bulls. But when we look at the 5-minute chart, this was the day. So, what a strong bull trend day. And you're saying, how can this be a bull trend day? Well, the daily chart traders, if you go on Fast Money or any of the CNBC shows, they'll say the market, they'll say probably something, really important happened yesterday that rallied the market, and obviously the market's accepting it today. But this was the day you had. On a 5-minute chart, my one thought was two things. One, we had a bull breakout above a channel and right here. So here's a channel. It's basically a leg in a trading range. The market broke above it. And you can see what happened on bar one. We pretty much got a measured move up of the trading range. So a measured move up takes you to 1775. And look right here, 17.5. But either way, yesterday was such a climactic day. Even though we had a lot of trading range price action here and we kind of drifted sideways to up later in the day, I thought overall on the day it was fairly climactic. And because of that, I thought there was at least a 75% chance that we would go sideways for 2 hours beginning before the end of the second hour. 50% chance that the market will get a trend from the open. Let me back up. 50% chance the market will have follow through buying on the open and then have 2 hours of sideways trading. 75%. So that is the 50% probability. 25% chance we were going to get a bull trend or a bear trend on the open. So bar one is a good looking bull bar. And Ace, so Ace said doesn't look like a great bull trend on a 5-minute. Yeah, that's the joke, Ace. And where I was getting at, because I may not have been clear with that, is a lot of bars, you can look at bars right here and you look at this bar and you say, what a great bull trend bar on the daily chart. But then when you actually, crack open the bar and look at the smaller time frame, you realize that there's a lot of sideways trading through here. So because of that, this is not as strong of a bar as it could be. It's still follow through, but we went sideways for most of the day. And it's actually pretty interesting because this is actually a fairly lower probability event. We had the high of the day set at bar 9 and the low of the day set at bar 12. And that typically does not happen. So, anyways, back to bar 1. Bar 1 is a good looking bull bar, possible exhaustion going from yesterday's rally. Are we always in long? We are. We have not been always in short at any point today, but it's probably exhaustive and climactic. Climactic bars typically lead to sideways trading. They don't lead to reversals. If you go to Al's video course and you look up the climactic, it's not climactic reversals, it's just climaxes. It's in the fundamentals of the video course. What you'll remember is most climaxes lead to a trading range lasting 1 to 3 bars. So, big bar, I'm expecting sideways for at least a couple of bars. And then bar two, we have a big bear bar. So, something important happened on bar two. The bears that sold above yesterday's bar 81 and scaled in made money relatively quickly. And that's a warning that we're going to go mostly sideways. Bar three is an inside bar. You can see the bulls bought below one on two and they made money. Some bulls bought the close of one and they're disappointed by the sell off on bar two. So, what do you think they're doing on the open of bar three? A lot of those traders sold. They bought, they bought more below one or on a pullback, and they used the rally here or the high of bar three to try and exit their longs. With bar three being an inside bar, it's a possible 1 bar final flag. You can call it a triangle, but for me, I need to see more selling pressure. By the way, another thing I forgot to mention about yesterday and that I want to clarify, yesterday did not have any closes below the moving average. And that happens, and it's very rare that that actually happens. Maybe we had one or two last year, but you can pretty much assume that maybe 3 times a year or 2 times a year, you'll get a day where you don't get any closes below the moving average. And that's less common for bear trends for a number of reasons. But, anyways, that's something that's worth noting. So, bar four, we broke above bar three, two, and one. But look at the signal bar. Three is a bear bar, and it's a weak stop entry buy. And because of that, you'll have less traders buying above three and more traders selling above three. It's possible that the rally from the 81 low yesterday to the bar one high right here is strong enough to get a second leg up. So some traders will buy, they'll buy above for at least a scalp. But bar four is fairly disappointing for the bulls. Bar five, strong bull bar. Are we always in long? We are. We're always in long from yesterday. In general, to get a buy the close rally, I like to see consecutive bull bars with at least one closing above their midpoints. Ideally, I want to see both closing above their midpoints and one closing on their highs. So to me, this is the minimum criteria for the market to be always in long. But if you're buying here, this is fairly dangerous. And on most days on the open, you often hear me say it, and you often hear me type it in the blogs, and that is most of the time the market goes sideways for the first 6 to 12 bars. So a lot of times, whenever you see a trend from the open, I always assume that something is wrong with it, and it's going to be something that's parabolic or reverses into a trading range. I think here is especially higher probability that this is going to fail. What about selling the close of bar five, betting on exhaustion? You can, but stop placement gets rather difficult. You probably need to stop a measured move of both of these bars at a minimum. And I don't think most traders should do that. Better to just wait for a signal bar. Six, follow through buying. So still always in long. Okay to be long and okay to buy the close. But again, like I mentioned, we have a weak buy signal above three. We have a big bull bar on seven and small follow through. So, what do you notice about this breakout? You've often seen me show this example. I show it pretty regularly right here. This is an example of a strong bull breakout. Lots of consecutive trend bars. The bars aren't too big. There's no overlap. This is a very good looking breakout, and it led to sustained buying. Here today, this is not sustainable, and the context is bad. Climactic behavior going into yesterday, probably going to go sideways. The moving average I use regarding this question is a 20-period exponential moving average. Bar 7, bear bar, probably buyers below 7 due to the micro channel that began on 2, but 7 is a warning that traders are less interested in buying up here. For me, I want to buy closer to the moving average, and I'm expecting a trading range day. What about it's okay to sell out of longs below 7? As far as selling, I would not. I think it's better to wait for more selling pressure. And then an inside bar on 8, bad high 1 above 8. So again, the bulls, they bought the close of 6, disappointed with 7. Disappointed with bar 7, and because of that they used bar 8 to exit their trade. 9, bull breakout, but a bad high 1 above 8. To me, this is not where you buy. This is where traders are taking profits. If I'm buying, the only way I'm buying here is buying the close, and I'm putting a stop below 9, and to me that's a low probability trade. It's probably better to do the opposite, and that's exactly what happened on 10. The problem with 9 is it's a parabolic wedge, 1, 6, or 7, and then 9. Wedges, it's wedges, or it's really common for wedges to not look ideal. A wedge is simply 3 pushes up, 1, 2, and 3. It's 3 attempts. And whenever you have a parabolic wedge, especially when the context favors a trading range, it can be really dangerous. In general, most of the time, it's dangerous to enter on the third leg. And it's possible this is the first leg up to bar 4. Bar 5 or 6 or 7 is the second leg. We have a pullback, and then 9 is the third leg, and 8 is an inside bar. Inside bars are typically final flags, and that lowers the probability of buying above 8. So I thought 9 was more of a sell the close bar than a buy the close bar. 10, big bear bar, enough of a surprise always in bears. I'd get out of shorts below 10, or I'd get out of longs on the 10 close. Aggressive bears can sell. And then 11, another big bear bar. Still always in short on 11, okay to sell the close. But what do you notice? We're near the lows of the day. To me, when I see bars like 11 consecutive bear bars near the low of the day, I'm willing to sell, and I'm okay with selling the close of 10 or 11. But there's one thing I'm expecting, and that is a trading range day. So if I am selling, I'm going to be really quick to get out. And you can see that's what happened on 12. Traders sold the 11 close right here, and the market came near the 4,500 big round number. It came within a point of the 4,500 big round number. You could say it tested back into this trading range right here, and traders bought into the close of the bar. 12, a bear bar, but closing at its midpoint instead of below its midpoint. As strong as the sell-off looks from the 10 close to the 12 close, to me, it's a little bit problematic, and the context is bad. We're in a fairly strong trend when you include yesterday. And because of that, since we're in a fairly strong trend, 12, you have to look at 12 and ask yourself, if 12 is such a strong sell the close bar, why did traders buy the close of the bar? In other words, I don't remember when, maybe it was 30 seconds, 40 seconds, a minute into the bar. But at some point, you had everybody buying instead of selling, and that's what put a tail below the bar. Look right here. This bar sold off. It's got a tail somewhat below, but look at the high of this bar. The close of this bar, bar 10, is 20.25. The high of this bar, bar 11, is 20.5. That means there were so many traders that were interested in selling that the market went one tick above the 10 close and immediately went down. When you look at 12, do you feel a sense of urgency, or are you disappointed? For me, if I'm a bear, I'm disappointed when I look at 12. And that makes me think we're going to pull back. 13, big bull bar. The rally from the 12 low to the 13 high is disappointing for the bears. And it's a strong enough rally from this low to the high of 13 that the first reversal down will probably fail. The first reversal down will create a low one short. So we have a bear breakout here. We have a pullback up to 13. And if we try to resume the bear trend, which even though this is technically a trading range, you can call it a bear trend from the high of 9 or 10 to the low of 12. The bears hope it's a bear trend. So when they see trend resumption down, that will be a low one. And there's the low one right here. But who wants to sell below that bar? Who wants to sell below 14? The reality is there's probably more buyers below 14. It's common in this situation for traders to look to buy a 50% pullback. And you can see right here, low of 12, high of 13, 50% pullback is really close. And the market didn't quite reach it. However, you can see what happened. It came near it and then the market bounced. Give me just 2 seconds. 15 is an inside bar, but probably buyers below. You had some bulls that bought the close of 13, even though it's not really a great buy. Some bulls will buy the close of 13. Then you can see we pulled back on the very next bar. So the bulls who bought the 13 close disappointed with 14. And look what those bulls did on the 15 high. The bulls that bought the 13 close disappointed with 14. They got out on the 15 high. 16, same thing. We triggered a buy above 15. So for the bulls, it's second leg up. But the risk for the bulls is this is a pullback in a possible bear flag. And the bears want a second leg down in a test of the 12 low. 17, outside up bar. To me, the bears are losing control. And the other thing is it was reasonable to buy up here. So the odds were this rally, as strong as it was, even though it was weak, the odds were this would be either a trading range or a bull trend. And because of that, the odds were against the market forming a bear trend. So to me, 60% chance we get up. I say that. Probably a 60% chance we get up here. 80% chance the bulls that bought here and more lower are going to get out break even. Always in traders, I would get out probably above 13, certainly above this bull bar 17, closing on its high. 18 consecutive bull bars. Are we always in long? I don't think so. To me, it's a 50% pullback of the sell off from the 11 high, from the 10 high to the 12 low. And the risk is it's two legs up. But it's certainly a problem for the Bears. Surprise bar on 19 may get a small second leg down, but the rally from the 12 low to the 18 high is so strong that there's probably buyers below. So if there's sellers above and there's buyers below, you know the market's probably in a trading range. 20 inside bar, probably buyers below, probably sellers above. You can call it breakout mode, but we have targets above the 9 low, and we may have to get a second leg up from the 12 low to the 18 high. 21 inside bar, probably low probability for buying above or selling below. Most traders better off waiting. The market's deciding right here. Is this going to be a bear flag that leads to a second leg down and a break below 12? Or, in other words, is this going to be this sell off, pull back, second leg down? Or is this going to be a bull breakout of a bear flag? We rallied, pulled back. Are we going to break out above the bull flag and maybe try and get some kind of measure move up to here? Obviously, we got the upside breakout. Strong enough surprise on 19, probably at least a small second leg down. But look what happened on 20, 21, and 22. We're not getting a second leg down. So on a smaller time frame, 19 is a trap. 23, bear bar, inside bar, but low probability sell below. 24, that was the attempt at the second leg down. Bears sold the close of 19, disappointed by the rally. And what did they do on 24? The close of this bar of 19 is 13 and a half. The low of 24 is 14.25. So the market came within three ticks of the 19 close. And then it reversed up. 24, 25 breaking out above 24 in really the past 5 bars. Highest close in the rally. That's good for the Bulls. For the Bears, they hope it's a wedge, 13, 18, and 25 or 26. And because of that, the Bears want a wedge, so they want any sort of buy to trigger and then turn down, forming a bear bar. But even with that logic, the problem here is one bear bar closing above its midpoint, 3 dojis, one big bear bar, but here's a big bull bar closing on its high. Here's another big bull bar closing on its high. Both of these bars have virtually no tail. Someone asked about the right here. The two moving averages I have is a 20 period moving average, and then I have a 221 moving average, EMA moving average, which is down here. And all it does is just represent the 60-minute chart. So over here, there's the 60-minute moving average. It's a 20 period moving average. An input of 221 almost gets you the same line. I'm not worried about this one being accurate because I'm more interested in just it's a reminder. If I zoom out of the chart, I can see we haven't touched the 60-minute moving average in a long time. I'll talk more about moving averages at the end of this review, though. So we have a wedge, but the problem is the bull bars are stronger and the bulls are just getting more buying pressure. So that makes me think this might be an endless pullback, and it's possible this is just a sell vacuum. 26, it looks like the bears are losing control. Still possible wedge and a possible bull breakout of the wedge. We had a spike on a smaller time frame, 12 low, 13 high, and we pulled back on 14. Therefore, I can draw a channel right here. And for the bears, their argument is a bull breakout of a channel, and they want the market to turn down and test the bottom of the channel. 27, doji. Possible bad follow through after 26, and it's a possible second leg trap. Rallied up to 18, pulled back, second leg up to 27. That's reasonable argument, but again, too much buying pressure that I think we're going to go a little bit higher. Now, what about buying right here? Well, part of the problem I have with buying right here is the 9 low. The bulls who bought the 9 low, guess what? The bulls that bought the 9 low right here on 10, obviously, they pretty much bought the worst low of the entire day. So if you bought the 9 low and you got trapped on 10, you're obviously disappointed. So if you did take that buy, are you really going to be all that eager to buy again at the exact same price level? Of course not. So you may have more traders selling up here than buying. 28 bear bar, but we've had a micro channel since 24. Probably buyers below 27, buyers on the 28 close, and buyers probably near the 18 high. So I think we're going to go mostly sideways. Bear bar on 29, but what do you notice? We closed the gap and we tested the 24 high. The high of bar 24, 19.25. The low of this bar, 19.5. So it tested the break even stop to the tick, stopped out those traders and turned up, but it still could not fall below the 24 high. So the bears that sold the high of 24 right here are still trapped. we'll probably get a second leg up after the rally up to bar 26. 30 bull bar closing on its high, probably going to go at least a little bit higher. But you can see what happened. Instead of it going a lot higher, what did traders do? You had some traders who bought the close of 27 or 26. They were disappointed by the sell off down to 29, and they used bar 30 to exit back at the high close. It's also a retest of the 9 low. We're always in long and we're holding above the moving average. All good things for the bulls. The bulls are hopeful they can get a small pullback trend. They have an open gap. It's a negative gap, but it's still an open gap. The 18 close and somewhere over here. So this is a negative gap where my cursor is. However, small pullback trends are not all that ideal when you have a strong sell off like we've had down to bar 12. Look at this day. Notice how the rally, there was really not a lot of selling pressure. You could say there was selling pressure here, but that's after a 12 bar fairly strong rally. So the point I'm making, whenever you get a strong sell off on the open, it greatly lowers the probability of getting a really strong trend day. An exception was January, I think it was January the 2nd or January the 6th. Let's see. Here we go. So it was January the 6th of this year. You can see we gapped up and we had this incredibly strong sell off and then a very strong trend. But the only difference here was context. We were in a trading range day on the prior day. We had a strong breakout and bar one was followed through. And this big bear bar and this big bear bar is just a retest of this area. So this is not the same pattern that we're getting today. So where were we? There we go. 32 bull bar closing on its high. I think that the upside is probably limited, but I wouldn't be surprised if we have to get above the 9 high. The bulls, they obviously want to measure move up, but I don't know. For the bears, the one good thing the bulls have right now is the bears are having trouble making money below bars. But if the bears start making money above bars, the odds will increase that they're going to make money below bars. 31 doji, but a lot of overlapping bars, more disappointment. Bull breakout on 34, second leg up from the rally up to 26. All good for the bulls, but the risk is increasing that this is a wedge, and the wedge is getting more defined. Patterns that don't look great or that are hard to recognize typically have a minor effect on the market. But the more clear that a pattern becomes, in other words, the more clear that a leg count is, the greater the risk of a deeper pullback. That's why small pullback trends have so much trouble reversing. We've had quite a few small pullback trends. Even here, this is kind of an example. The market sold off here, sold off here, sold off here. It's a wedge. But the problem with that is it's a minor pattern. And when it's minor, it's harder to see it. So it has a minor effect. Here, go back to where we were. Here, 34, it's 3 pushes up. Although it is in a tight bull channel, the odds are getting higher that we're going to start to pull back. And you can see what's happening at new highs. New high, at least it's not a new high on the day, but it's a new high relative to the rally. New high on 18, traders sold on 19. New high on 26 right here. And look what happened a few bars later. Traders sold. New high on 34 right here. What do you think traders are going to do? They're probably going to use it to sell. And then we got a bear bar on 35. Always in traders. I would get out below 35. To me, if the bulls that bought above the 13 close, they've had a rally lasting quite a few bars. It came really close to 1 times their initial risk if their stop was down here. I think it's okay to get out of shorts here. It didn't trigger on 36, so some of the bulls who had a stop below 35 never got taken out of the trade. But you have some bulls who bought the close of 34 and they're disappointed with 35 and they may look to get out break even at the 35 close after, excuse me, bulls that bought the 34 close disappointed with 35 and they may look to get out break even on 36 back at the 34 close. 36 inside bar, high one buy, but small pullback trend, yes, but you're just so close to resistance. It's getting more and more dangerous to buy up here. 37, another wedge. One, two, three. It's possible that the rally to 36 reset the count. So now it's three pushes: 36, 34, and then 37. Big bear bar on 39, excuse me, 38. I think that's a strong enough bar. We'll probably get a second leg down. So it's okay for traders to be flat here. Give me just 1 second here. 39, bull bar, but traders, instead of buying new highs or selling, bears sold and then bulls bought a pullback. 39 is an inside bar, but eventually there's probably going to be sellers above. 40, another new high and a bear bar. Eventually, one of these stop entries is going to be successful. And because of that, I think it's reasonable for traders to exit below 40. 41, strong bear bar. Strong enough bar. We may go at least a little bit lower. So I would be out of longs at this point. And then 42, a big bull bar. So the bears, they're having trouble breaking below the moving average, but you can see what's happening. The bears are increasing in selling pressure. And because of that, eventually we get a high pullback, new high, deeper pullback, new high, deeper pullback. Well, eventually, what do you think is going to happen? We're going to get a lower high instead of a new high and a second leg down. And it's possible this is the lower high. 42, good bar, but a possible pullback from the 40 high to the 41 low. 43, a weak doji bar. Some bears, they sold at close of 41, scaled on higher during 42, getting out break even. You have other bulls who they look at 42 and they expect a pullback, but they don't want to buy the high of the bar because it's at the top of a trading range, of a tight trading range since bar 34. So some traders will try and buy a pullback on 43. 44, bear bar, but failed to close below the moving average or close below 43, lowers the probability, but still possible lower high and a downside breakout. 45, a bull bar. Most traders should wait for a breakout up or down. 45 or 50, excuse me, 46, we broke below the triangle and the moving average and we found buyers. What about buying above 46, betting it's a 20 gap bar buy? I would not. To me, there's too much risk that the market is going to go sideways and it's a bad buy signal bar that increases the odds that there might be more sellers above than buyers. And that was the problem with 47. 47 failed to go above 46 and it closed as a bear bar, closing on its low. For the bears, they see a bull flag. They see a rally and a pullback, and they know this is a bull flag. The bulls, they want an upside breakout. And the bears, they want the opposite. They want a downside breakout. So if we have a really big entry bar on the next bar, that would be a bear breakout below a bull flag. 48 consecutive bear bars. Good for the Bears. Are we always in short? No. The Bears need to do more. And they're doing enough to disappoint the Bulls, but this channel up is still fairly tight. So it's possible and it's probable that this sell off here is minor. If you look at a 15-minute chart, already on one, obviously. I'm going to change to let's change it to this right here. So we're right here, and you can see the channel's tight. And because of that, we may get a deep pullback, and that's what happened right here on 49. 49, you can see traders bought the close of 48, and it was 2 or 3 legs down, 1, 2, 3, or the first push being 44, second push 46, third push 48. And 48 was the best looking bear bar, but it's 3 legs down. So traders bought the close on 49. But the channel down from the 40 high to the 48 low is fairly strong, or it's tight, is a better way to say that. Therefore, there's probably sellers above. What about buying 49, betting on a pullback and a test of the moving average? I would not. 49 is a really big bar, and big bars force traders to incur big risk. And when you're taking a stop entry, you typically have low probability, and you want to be compensated for the low probability. And the way you're compensated is you typically get small risk. So for me, it'd have been better for the Bulls if this was a smaller bar. Weak follow through on this bar right here. So traders sold, and the Bears got a downside breakout. Are we always in short on 53? We might be, but the problem here is it's a climactic bar in the middle of the trading range. Remember what I said over here? Whenever you have climactic bars like this, big buy climax in the middle of the trading range, you always have to be worried about a second leg trap. First leg was here, pullback, second leg. So to me, good bars are often traps in trading ranges. Good bear bar, but this could be a trap in a trading range day. And some traders sold 53 and were disappointed on 54. This was a trade I mismanaged a little bit. I sold the close at 53 and I had a target a little bit down here. And as the bar was going down, it was taking a while. And I got distracted for about 30 seconds. And when I looked back, the market got all the way back to my entry price and it ended up selling a little bit higher and getting out break even on the entire trade. But the point I'm making is a lot of traders, when they take this kind of a sell, they want the market to go down quickly. And if the market starts to reverse, or in other words, if traders sell and the market goes down and traders start buying back shorts or buying, a lot of traders will scalp out. So the mistake I made was I should have gotten out. I should have been faster to get out as the market turned up and at least gotten, a point. 54. What about buying above? Some bulls will, but to me, the sell off from 52 and 53 is strong enough for at least a second leg down. What about selling above 54? And it's kind of hard and a little bit dangerous because it's a possible second leg trap, but I think the bulls need to do more. 55 triggered the sell above 54 and turned down, but probably buyers below 55 scaling in lower. But the buyers may not come in until somewhere down here. 56, good for the Bears, but tail on 55, tail on 56, and a tail on 54. and you're in the middle of the trading range. So this is probably an area where traders are taking profits more than where traders are selling. 57, reversal up. What about buying the close of 57? You can, but if you're buying the close of 57, it's kind of like the opposite of 49. The context makes sense, but it's the same problem as 49. If you're buying the close of 57, your risk is really, really big. So this is one times your risk, and your probability is small because you're buying on a stop entry in a tight bear channel. So one times your risk is up here. And because of that, a lot of traders, rather than buying the close of 57, they'll wait to see the follow through and they'll chase the market up, or they'll buy a pullback. And a pullback would be maybe the midpoint of 57. And you can see that's what happened on 58. 58 also tested the 56 close. Some bears sold the close of 56, disappointed 57. They got out break even on 58. As far as buying the close of 57 or above 57, it's probably okay, but I think it's better if traders use a wider stop if they are buying above it. And the reality is, they're probably better off buying more below 57. 60 broke out below 57, but a wedge down on 54, up on 55, down on 57, up on 58, down on 60. And then, no surprise, 61 reversed up. Always in bears. I would probably get out above 57, and I don't think they sell again. I think it's if they do sell again below 59, which I think is kind of dangerous, I would get out as the market's reversing up. And I think the last place bears get out is above 61. 61, okay, swing buy. 62, bad, not bad follow through for the bulls, but a little bit disappointing. Probably buyers below 61, bad, low one, short, below the bar. And because of that, you'll have some traders buying the close of 61, betting on higher prices. And look what happened on 63. The market went straight up. It's sort of the same logic over here on the daily chart. We have a bull bar and then decent entry bar. The entry bar is small, but it gapped up. So on a Globex market, your entry bar looks more like this. It's a big bar. And anyways, the point I'm making is this bar right here, 2 days ago, the 28th, it's a bad low one short. And because it's a bad low one short, you will have less traders selling the bar, and that increased the odds but get an upside breakout. 63, strong bull bar, but I'm going to go back to my favorite, one of my favorite slides of at least this end of day review. And this is this euro dollar slide right here. Strong bull bar closing on its high and middle of a tight trading range. So it's greater risk of a climactic bar. Climactic bars in a trading range have an increased risk of reversal. So if bulls are buying, they need to be quick to exit. And that's the same mentality I would have here as a bull. If I'm buying the close of 63, I got to be prepared to have an exit plan. And one way to exit is get out below a bear bar closing on its low. Bear bar closing on its low, but a 4-bar micro channel in the market just became always in long. What about selling below 63 or selling out of longs? It's okay to sell out of longs, but look what happened. The low of 51 here and the high of 64, it's testing an area where traders got trapped. So remember what I said right here? This was the bull flag, and we may get a bear breakout below the bull flag. Look what happened. The market went a little bit lower below the bear flag, but this is still an area where bulls got trapped because the bears got a bear breakout. And that's what it did right here. The market retested that price level and went sideways. Some bulls who bought the 63 close will be disappointed with 64 that they will use. They will look to get out break even at the 63 close. And that's what happened on this very next bar on 65. That's also what causes high one buys to often be weak bars. And the reason that happens is you have bulls who buy a bar like 64 And then 65 is a disappointment bar. It's a bear bar closing on its low. On a smaller time frame, 64 is a bear trend bar, and it'll probably get its own second leg. Therefore, because of that, you'll have some traders selling up here, betting on a second leg, and you'll have other bulls disappointed who bought the 63 close looking to get out break even. 66 bull bar closing on its high. A little bit disappointing for the bears looking to sell. Looking to sell above 65, but still top of a trading range. We may have to go above the 64 high. We're always in long, and we still may get a second leg up. In situations like that, if I'm ever looking to sell a high one, which this one's a little bit more dangerous because the market just flipped to always in long. But if I'm ever looking to sell a high one and then 66 closes on its high, even if it filled my order, in other words, if I had a limit order to sell the 65 high and I got the order got filled and now I'm in the trade on 66, I would get out on the 66 close. There's too much risk that we may get a big second leg up and we could still get an upside breakout. So it's a more dangerous limit order sell above 66 now. 67 bull bar closing on its high. I still think the bears who sold here will make money. And 68 is relieving those bulls, those bears who sold the 67 high, scaling in higher. Excuse me, that was 65 and that was 66. So if I sold the 65 high and I got filled during 66, I would be out. I would get out and just take the 1 or 2 tick loss on 66. And you can see some traders who didn't do that, they sold and scaled in. Look what they did on 68 and 69. They got out at their original entry right here. And that's what caused 69 to bounce. 70, bear bar, second leg down, testing the midpoint of this area. And then you can see we sold off into the close and pretty much went sideways for the rest of the day. For limit orders, buyers below 1, you can sell above 3, but you can see what happened. The bears that sold above 3, they got trapped. Some bears sold, scaled in higher, and if they were not very quick to get out, you can see what happened on the open of 5. It went straight up. And then probably sellers above 8 or 7, but fairly challenging to do. Probably sellers above 12 scaling in. But then my only problem with selling 12 is this bar, as it was going up, whenever it went above 12, was a pretty strong bull bar. So that's not really all that ideal. The momentum is pretty strong. Therefore, I think some traders might pull their order, but it's okay to sell, scale in, get out break even, or sell a couple points above and get out at the 12 high. Probably buyers at a 50% pullback at 13, bulls buying below 14, even bulls buying below 18, but fairly high in a range. And you had a major surprise on 12. Therefore, if you're buying below 18, you really need a wide stop. And if you get if 19 is a big bar and 20 is a big bar, you got to be really quick to get out. Sellers above 20, buyers below these bars, buyers below 27, scaling in, but a little bit dangerous. Better to buy closer to the breakout point, like the 18 high. Buyers below 32, and sellers above these bars. And let's see here, limit order market through here, buyers below, sellers above. Probably sellers above 54, but that's one I wouldn't take. Buyers below 55 or 56, and probably here I think it's really just too late in the day. Buy the close, sell the close. Probably buy the close on 5, sell the close 10 or 11, and probably maybe by the close 25, but third leg up, so pretty challenging and not really good buy the close anywhere through here. If you sold the close of 53, you're disappointed with 54, probably just get out, break even. And I thought it was probably okay to buy the close 62, betting on a test back in this area. But again, forcing you to buy at the moving average. Not really good buy the close, sell the close trading today. Okay, let me take a look at some questions. Okay, question. What are your thoughts on selling below bar 48 right here if triggered? Is bar 48 a parabolic move on a lower time frame? It seems like we needed one more leg up, but sometimes it sells off in this kind of context. Yeah, my problem with selling, 48, it would have been better if the bar triggered. That I agree with you. So if you're front running the close, see, if you just sold the close of this bar right here, yes, this happens a lot in a trading range where the bar doesn't trigger and it immediately reverses up. My only problem here with selling the close of 48 is it's three legs down. We sold off on, and this is on a smaller time frame, but you can see it on a 5-minute chart. We sold off on 44, pulled back 45, sold off 46, pulled back 37, and we're selling off again on 48. But it's okay to sell the close. Had I sold the close, which I think it'd be better to sell on a stop one tick below 48. Had I taken that trade, I could understand logic. I think it's reasonable to put a stop one tick above 48 high, betting that if it is going to sell off, it's going to be rather quick and it should not go above it. And then right here, what do you do on this bar? The traders that got stopped out, had they sold, they'd probably wait. Big enough surprise, 49, probably a second leg up. But then you see this bar right here, 50, and that's a weak follow through bar. So you will have some traders selling the close. And you can see 51, bear bar, and then obviously 52 sold off. Question: is it reasonable to think that bar 13 would have a second leg up given the context of the prior bars? Yes, that I absolutely agree with this question. So what Seth is asking is it reasonable for bar 13 to get a second leg? It's very reasonable that bar 13 gets a second leg. That's why a lot of traders, you see the breakout on 13, but really, if you think about the whole move, the breakout began at the 12 low to the 13 high. So if we look at a smaller time frame, like a 1-minute chart, let's see if we can find it here. So here's the sell off. And look, so you see this close, 10:30, the close is 6.5. Look at this bar right here. The close is 6.5. And to me, when I see a bar like this, I know that it's strong enough. It'll probably get at least a small second leg. That's why a lot of traders exit here because they know if it's going to get a second leg up, they don't want to be in the trade. They don't want to be short. And then the bar grew, the breakout got bigger. Now, this whole thing is probably going to get a second leg. And that's why, look what happened. Traders bought a pullback and the market went sideways and ended up getting eventually a second leg up. But you are correct in your thinking. Why a lot of traders would just exit when they see this bar start to get big because they know the odds are the first reversal down will fail, which means you'll probably get a second leg. Okay, question. Could the short at 10 be predicted and traded? I didn't today. I didn't sell today is what I'm assuming they're saying. But now I noticed that it was an overshoot of a trend channel line from August 25th. Yeah, I'm sure it was some form of an overshoot, but you can look at this chart, and if you think about the logic of what's going on, we had climactic behavior yesterday, and we're forming a trend from the open, but we're getting a trend from the open after a yesterday's strong trend from the open. So for me, when I see a big bar one, and then a biclimax on five, and then another bar on bar nine, that's a parabolic wedge, and parabolic wedges often lead to pullbacks. And then when you see a big bar like this, you have to understand that traders are exiting, they're panicking out of longs. So if you're quick, then you can sell. That's why I'm always thinking about always in. I'm always thinking, even if I'm flat, I actually did not watch the market until this bar. I had some things I had to do this morning, but I got lucky and I started looking at the market right here and I was able to sell and scalp out for 5 or 6 points. But the point is, the reason I'm bringing that up is had I been long, it doesn't matter if I was flat or long. It's all the same thing. I'm always thinking about the bulls and the bears. So I'm always weighing if I'm a bull, what am I doing? If I'm a bear, what am I doing? And if I'm a bull and I see a bar like 10, I have to be out of longs, which means it's probably okay to be short. Are you expecting a trading Were you expecting a trading range day because of the large move up yesterday? That's exactly it. Is it reasonable to buy above bar 17 right here? Yeah, I think it's okay to buy above bar 17. If I am buying above 17 right here, I'm going to be pretty quick to get out. So for me, it's a buy, and I'm hoping that the market races up quickly, but I'm expecting that the market doesn't race up quickly. The bulls have to overcome this big sell off. And the reality is they're going to have a very hard time overcoming. So if you are buying it, it's a swing trade. It's a stop entry. You buy above the bar, you put your stop below, and if you get stopped out, if the market triggers the buy on 17 and just races down and stops you out, who cares? You just move on to the next trade. More likely, there will be some sort of hesitation and warning. If you're long on 18, it's a good bar for the bulls, probably going to go higher, but look what happened. It's a big bear bar. So why did that happen? Because it's two legs up in a trading range. But what do you notice? The bulls that bought above 17 and put their stop below 17, they never got stopped out. Okay, question. Why do you use why do you only use a 20 period EMA that stands for exponential moving average and not other exponential moving averages, for example, 15, 25, or 50? Is there any reason for choosing 20? Well, the reality is the reason I choose a 20 period moving average is Al, through all the years, he used a 20 period moving average and still does today. Now, why do I not use other moving averages now? Because I don't like a lot of clutter on charts. And sometimes there's plenty of times where I accidentally delete, you can't see it here. There's plenty of times where I accidentally delete this blue line right here. And that is the 221 period moving average based on the 60-minute chart. For me, the longer you look at markets, the more you begin to be able to see and just kind of understand just by looking at the price action. So if I choose, the other problem is for me, I like a 20 period moving average because there's something about 20. It just seems like a reasonable enough amount of bars. Now, does it really matter? I mean, let's just do 15. Does it really matter all that much? Of course not. There's the 15-minute moving average. Okay. So what does that change about this chart? Really, to me, it changes virtually nothing. We have a tight bull channel. The bears are failing to break below the moving average. They broke below it here. That's good for the bulls. Broke below it here. That's good. But what happened right here? Beer sold, a test of the moving average. They sold it here. We finally broke far above it. We'll probably go at least a little bit higher. So you get the point. But for me, to answer your question, I don't like a lot of clutter on a chart. Can you explain what can you explain what type of behavior would make you switch your always in bias besides a huge bar like we had on 10? That is a pretty long question to answer, and it's pretty broad, but in general, it's always context dependent. So the mark always in, if you think about it, the always in direction can change based on a big bar, but it can also change based on context. So here at this point, the market was almost always in short before this bar happened because it's forming a parabolic wedge. One, two, three. So when the market starts to sell off, you have traders ready to exit. Okay, last question. Do you sometimes enter and exit during the development of a bar? I do that pretty regularly. So for me, like I said, I sold the close of 11 and I scalped out during 12. And the reason I scalped out during 12 was it's a trading range day. And I thought it was reasonable. For one, I had a decent size profit relative to the bar. There's no tail above this bar, so that makes it climactic. And I thought the bulls that bought below 1 or 2 during 12 would probably make money. So to me, it's always context dependent. Some days I'm willing to hold more and, manage the trade less. So I might sell this close and just wait for the bar to close and then decide what to do. Other days I'll sell and scalp out. And that will force me to have to take more trades and everything like that. But the management is all going to be around the same. Had I sold the close of this bar, I'm disappointed with 12. It makes sense to buy back shorts on the 12 close. Otherwise, you face the risk of getting this. So tomorrow, it'll be interesting to see what happens. We have strong consecutive bull bars, and that's good for the bulls. I think this is strong enough for a second leg up. However, middle of a trading range, I would not be surprised at all if the bulls get disappointed and we just go sideways for a couple of bars. So, as good as the bulls look here, it's a possible second leg trap. Obviously, the bulls are hoping that we rally all the way back to 4,600. But even if we get up here, we're probably going to be in a trading range. All right. Thanks everyone for watching. And tomorrow there will be another end of day review on YouTube. So be on the lookout for the link. All right. Hope everyone has a good rest of their day.